Investors almost invested in it because of a higher yield. So we are seeing a movement to diversification to maintain liquidity, find stability, and of course for growth. It is true that the selling point has been on yield, but you're seeing in fund managers now diversifying by looking for opportunities in offshore markets and FX opportunities with USD currency assets. We are also seeing them do a lot of consumer education to build trust and to expand their AUMs. Fund managers are also seeking to have holistic financial advice setups where they're selling on strategy as opposed to just a yield. I mentioned that fund managers are making an initiative to educate their consumers on the products and transparency on returns and whatnot. And advisory firms also exist where you can have an advisor be able to manage your portfolio for you as well.
Hi, welcome to another episode of Make Money the Podcast, the show where we not only tell you but show you what's happening to your money, why it's happening, and what could happen. Of course, guided by conversations with the experts of money right here. And today I'm happy to introduce our topic for this week, and we are going to talk about interest rates. What goes up always comes down, as gravity dictates. And this is no different when it comes to discussing about returns and interest rates. What we've seen over the past year is your high returns from 2024 have gradually come down, and what used to be 15-16% is roughly now around 8-9% and could even be headed lower. The goal of the conversation here is to find out how does this change the investment play and landscape. And I'm happy to introduce my guest for this week. Ms. Naomi Atera is a corporate finance analyst at Rock Advisors, and welcome to the podcast.
Thank you, Kefa. Happy to be here.
And going for the bull's horn, as we may call it, or the bullseye, how has the investment landscape, in a sense, changed as we are talking of, looking at whichever interest rates you might choose to see? And up here, what I'm looking at is effectively the central bank rate, the return on the 1-year Treasury bill, and some of those returns on select money market funds. And what you can see effectively is what we've just introduced. It's a graduated fall in or a drop in those returns.
Yeah.
How does that change the game for us in investing?
Recently, CBR rate is at 9.5%. MMF rates, we have seen a decrease from the 15% to a net of 8 to 9%. 91-day T-bill, we are seeing 15% movement to 8%. So basically, the impact of this will be, first of all, there'll be a decrease in passive income that the investors are earning from it. This leads to a shift in the capital to higher yield opportunities like equities, where we are seeing an increase in the valuation prices given stock movement.
We've seen interest rates, let's say for the 1-year paper, it's 16%, now around 8%. So basically it's halved and gone down by about 8 percentage points. If we are to look at the trajectory, or if we are to chart up the path, then it dictates almost like we are going to keep going lower and lower. The question here is how low, in a sense, can you go when we see a moderation in those interest rates?
It's true that we have seen a decline in the rates. However, we are not likely to see a decline to zero compared to developed economies like Japan. This is because, first of all, the government of Kenya is heavily reliant on domestic borrowing. Therefore, they would like to keep the interest rates at an optimum for a good investment return for foreign investors or internal investors. There is also a need to keep the interest rates at an optimum for flow of capital, which has an influence on the Kenyan shilling currency.
When we are talking of this changing landscape, and like you did mention, is your sort of easy investment vehicles, your money market funds, your treasury bills, your treasury bonds have come down. It dictates that switch in terms of where people put their money. Are you, in a sense, seeing that already happening? Or are people willing to accept 7, 6, 5% as the new return?
Investors almost invested in it because of a higher yield. So we are seeing a movement to diversification to maintain liquidity, find stability, and of course for growth.
When you talk about also the opportunity presented by higher yielding assets, you talked about equities, and here in specific we would look at the Nairobi Securities Exchange as a place to buy equities, perhaps offshore, if you're inclined towards that direction. The question here is, do we have an investor base that's well aware of these opportunities? Are people well aware that when interest rates go down, then there's somewhere else where perhaps the return is getting better? Are people who are more familiar or more accustomed to your money market funds, to your bonds and whatnot, are they now more aware that, hey, there's an opportunity to pick up a higher yielding asset? And are they also aware of the risks presented and opportunities in a sense?
My feeling is that the consumer education on such products is quite limited, but there is opportunity for growth as a market. Investors are seeking advice from firms like us, and from fund managers are also providing education on the assets they're investing in. So there is an opportunity for growth there.
We come to fund managers like yourselves and what you are doing in a sense. And if we go back to last year, there was an accusation that you guys are one trick pony, in a sense, you just sell high returns. It's an easy investment. It's a government paper. They'll pay up, lock in 15, 16, 17%. With that game changing, are we seeing that you guys have more tricks up your sleeves beyond just selling me high returns, beyond you selling me a money market fund, beyond you selling me a bond fund or the likes? How are you embracing this challenge in terms of pushing out more of your products and more of your investments?
It is true that the selling point has been on yield, but you're seeing in fund managers now diversifying by looking for opportunities in offshore markets and FX opportunities with USD currency assets. We are also seeing them do a lot of consumer education to build trust and to expand their AUMs. Fund managers are also seeking to have holistic financial advice setups where they're selling on strategy as opposed to just a yield, and they're also selling on a retirement planning and whatnot.
Working with a fund manager, I don't know whether you've ever gotten that accusation that, hey, especially last year when, it was easy to invest, it was easy, like I did mention, it was easy to market 15%, 16%, 17%. I think we got as high as 18%, depending on the asset class that was there. And what we got from conversations is, fund managers are just sort of lazy, sort of easy. Bring your money, I'm going to go invest it in a T-bill, I'm going to put it in a bank fixed deposit, and I'm going to go off and play some golf and come back later. If you need your money, I'll just share with you that.
Exactly.
Is it now time that we do see that actually there's some work that goes into investing research, because people felt, it was too easy in a sense for fund managers in a high interest era?
It is true. Before it was easy to do that, but as you're seeing the rates declining, we are left with the opportunity for advisory firms like us to be able to showcase our skills in advisory and research and market knowledge. Yeah.
Sure. What effectively are you now telling clients when I come to you and tell you, hey, your MMF was giving me 16%. I've just looked at the paper and you've published 9, 6, 7%. Are you facing some of those questions, and how would you respond to that if, in a sense, I was your customer and I'm like, hey, your annualized return on your money market fund or something you advised me on is now down by half? Effectively, what kind of answers are you providing for some of your clients?
It's a valid concern. The best way to address it, I think, is to build knowledge around why the rates are actually going down. That builds a more informative and constructive conversation around it, and we take that opportunity as well to move them to higher yielding returns.
We now speak of high yielding returns, and on our last episode we were actually discussing offshore opportunities. And the question we tend to have is how much of investor awareness is there? Moderate to aggressive or moderate to more high-risk assets. In a sense, you're telling someone to get into perhaps the S&P 500 or perhaps to get into commodities, and we know how volatile that can be, or even crypto assets.
Sure.
How are you moving this discussion forward? Because I think previous conversations here have been on those asset classes that pretty much now household. You mentioned a bond, everyone knows a bond. You mentioned an MMF, that's a household name. How are you now expanding that knowledge to your clients that, hey, rates are down, this is no longer a double-digit return for you effectively, at least for the moment. As you sell on these higher risk or moderate to aggressive investment strategies to your clients, what kind of conversation and how are you approaching these conversations?
On your question on moderate to high-risk assets or securities to invest in, I think the approach will be banked on, first of all, assessing the risk profile of a client. Young clients have a higher risk appetite. Older clients will be more inclined to lower risk and moderate return in order to maintain funds for retirement. So the conversation will be centered around the risk tolerance that the client has based on their risk profile.
One more point here to discuss in terms of what you're informing your clients is the cyclical nature of interest rates. I think at the top of the show we did mention that effectively what goes up comes down, and sometimes what's down is up. Hot air rises, cooler air comes down. So it's a very cyclical market, and sometimes for people used to certain levels of returns, assuming someone who only got into investing last year and you've gotten used to the 12, the 15, the 18%. And in a sense, it's almost an expectation now that in the market that I go into the market, at least expect a 10% from whatever asset class, because last year what we saw is almost a convergence between your traditional and more vanilla products, as I may call them that, with your other asset classes. Is there an understanding in the market that also that what you get to see with interest rates is actually a cyclical nature, so that whatever is up today might be down tomorrow, and what's down tomorrow might be up?
Ideally, yes. That will be the position. But you find that traditionally, most investors looking into MMFs and traditional assets are not so educated on that. That is what advisors like us seek to help the market understand.
So let's create a scenario as we move towards the end of this conversation. I, Kefa Moirori, an investor, have a portfolio of money market funds, let's say 100,000 shillings of that. You have another similar pool of treasury bonds. So effectively, whatever you are holding gave you 15-16% last year. But now you need to change that portfolio to make it mimic the reality, which is those asset classes are no longer yielding. So what would be your advice to me? Do I start to apportion? Maybe the money market fund might be the quick one to liquidate and get into, say, equities, which have done quite well over the last 2 years. And do I also take the opportunity maybe to sell a bond and put it in a risky asset? What do you do when you're already locked into those high returns? Do you keep taking the lower return and, riding through what is volatility in rates and hoping for a higher return the next time out? Or do I now consider actually liquidating and moving my investment entirely into something more riskier, but also returning more in terms of what it's paying me?
The optimum strategy for you, Kefa, will be to have your investments as a basket, have them in tiers where you have one tier where it's liquid, investments in MMFs and T-bills giving you 9% right now, around 9%. Then you have a second tier where you're seeking stability, where you can invest in long-term government bonds, where the 10-year can give you 13.4% right now. And then you could have a third tier where you're seeking growth and higher yields, where you can invest in equities and rates. So I think that would be the optimum strategy to use when you're trying to balance out risk and yield.
It's very much a mixed basket from what I'm getting.
Yes.
There a sort of rule. I know in spending we have a 50, 30, 20 rule. Sometimes someone is like, take 70 minus your age, and then it gives you how much aggressive you should get and how much conservative you should be. Is there a one fit formula for where to put your money or how to invest depending on age and other characteristics? Or is it more of, let me decide for myself that, hey, I feel I'm aggressive enough, I can liquidate half my MMF and put that into equities, benefit from capital gains of perhaps 30%? Or do I just stick to maybe a formula that's there? Is there a formula that we have around that?
Investing is highly subjective, so that will vary from investor to investor. As I said before, based on your risk profile. As you say, the younger and the older cannot invest in the same way. And it also depends on how much you have to invest and the goal for investment as well. Those factor into having how you can pull your baskets together into the specific investments that are perfect for you. So
here the call I'm getting is you really need to have a portfolio that aligns with the times, or it's able to adjust quickly to these movements, so that you're not very much overweight in MMFs or overweight in bonds, and then rates catch you out and you're the one rushing to your fund manager and complaining, hey, I used to get 11-12% last year, you're giving me 8%, what's happening? You almost get a sense from some of the investors, especially when there's that knowledge gap, that without understanding that, then sometimes it feels like, oh, you're running a con on me in effect. Don't know whether you get that a lot also in terms of the feedback you do get.
We do, but most of our clients are quite not retail investors.
For retail investors, what's perhaps the play? Like what you mentioned is clear that institutional investors are more sophisticated, they're more knowledgeable to what's happening in the market. Can we have the same level, or at least a close, or mimic what the institutional investor knowledge is, or the base of knowledge is? How can we ensure that retail investors then would understand that, hey, asset classes are cyclical in terms of the returns you're able to generate from them, but also, how do we also ensure that retail investors are in the know of the riskier profile and perhaps where they would fit within a profile of either a risk-averse investor, a moderate to aggressive investor? How can we ensure that we are not basically losing that link that, one thing is happening in the market, but the same is not being understood across to one category of investors?
Okay, in terms of the knowledge gap, I feel there are a lot of resources out there. And aside from that, I mentioned that fund managers are making an initiative to educate their consumers on the products and transparency on returns and whatnot. And advisory firms also exist where you can have an advisor be able to manage your portfolio for you as well.
Last year, we sold high returns in the market. And by we, implying, of course, fund managers and other promoters of the different investments, we sold high returns. What will we sell this year in effect if we are continued growing this space and keeping customers and clients engaged in investing? What will we sell if we are not selling high interest rates this year?
An approach that fund managers will take is strategic growth, where you're telling your client this is a holistic growth to your portfolio, where you're investing with a certain goal in mind, with such a perspective in mind, you're able to stick to even long-term investments as opposed to just seeking high yield returns in a short while.
And that has been Naomi Atera. She's a corporate finance analyst at Rock Advisors. And the conversation has been on rejigging our portfolios to reflect the reality of lower interest rates at this time. And that has been another episode of Make Money, the podcast. And until I catch you on the next episode, make sure your money is working for you. Goodbye.